basis, things can change. But on the longer, medium-term basis, is it more important for us to see strong leadership out of those Mag 7 tech, media, and telecom stocks, or is it better long-term, medium-term, healthier to see a broadening out of the rally to small, mid-caps, and either other S&P 500 companies that are not in the top 7?
Yeah, hi, Dom. Look, I would argue actually both are very healthy. The large cap technology represent a majority of many of the indices. So it is, of course, great for the indices to see these stocks continuing to show excellent earnings and very good technical strength. However, with the recent drop in interest rates and some weakness in CPI, we have seen a real broadening out. It's helped small caps, it's helped mid caps. That certainly helps to add a lot of confidence to this rally at a time when many are concerned for a lot of the right reasons. But we haven't really seen any evidence of really technical deterioration to suggest that we're going to see a larger pullback. I mean, it's been healthy to see that pullback in technology. Meanwhile, sectors like financials, very important part of the market, industrials, REITs have all started to climb back. And I think that's actually a very good sign.
Elaborate on that, Mark, for a moment for those who are concerned that we're seeing some defensive tone to the market today.
Well, we did see some defensive tone of the market in the last week, but, technically we did not see any real technical undercut of the uptrend lines that have been in place. I refer to this as a great rotation. And as Tom Lee has talked about, this is the summer of small cap. We've seen an amazing period of outperformance by small caps versus the S&P 500. And I think that bodes well for the next 4 to 6 weeks to see continued gains at a time when many people are starting to get more cautious. So really, the technicals haven't given us anything to be concerned about. Breadth levels are in great shape, good participation, but that minor pullback in technology, we didn't do any damage, but it pulled back exactly where it needed to, and now we're starting to turn higher. So look, we are entering a time going forward when it is going to be a lot choppier. So to the bears' credit, the time between September and November historically has been difficult for the bulls. Some of that was due to 2008, but in general, it should be a choppier period in the months to come ahead of the election. But I'm still bullish. I don't think we've seen anything that would really deter us from staying long in this market, specifically on the small cap side.
Well, Brent, because Mark opened the door or window, whatever you want to call it, and brought up the election, let's talk about the election.
You sound so excited.
I know, and whether or not, we've heard so much commentary about whether or not we should be putting the election aside, not really caring about it, or focusing more on it because it'll have fundamental impacts on certain industry groups. Is the election something that's going to be a focal point for you as we approach this fall, given the seasonal chop that could happen? Or is the election something that we really don't care that much about as longer-term investors?
I think as longer-term investors, you don't care about it as much. Certainly it has an impact on things that you mentioned, like sectors and industries. But from an overall perspective, the U.S. economy is rather large. Companies and CEOs think beyond 4 years. And so if I look historically, the most important thing that happens when a president's in office or when they take office is where are you at in the business cycle? And this is something I hope we can all agree upon, is that it does appear we are later in a business cycle. We are not early or mid in a business cycle. And when someone takes office late in a business cycle, they tend to preside over a recession, and they tend to preside over markets that still are positive, but much less so than if you are in that office early to mid. And so it's certainly important, but it's not the most important thing. I think it has more of an impact on sectors, industries, and companies than it does the entire or the overall U.S. market, which I want to make just one quick point. Despite my outlook for more of a recessionary type of an outcome, we do agree with Mark on small caps in the summer of small caps. We ironically like small and mid caps because one way or the other, rates are going lower. I don't think the economy can continue to withstand the impact of higher rates. If we have a soft landing, it's likely because the Fed lowers rates, and I would expect the economy would broaden back out and the market would broaden back out. If, on the other hand, we have a recession, I would imagine the Fed acts aggressively and cuts rates, and people will start thinking about the opposite side, which is what markets tend to do, not think about what has been, and we'll start thinking about the economy rebroadening also.
Can I just follow up, Brent? The downdraft that we've seen in the last couple of weeks now, how much of that do you attribute to some of the fundamental and perhaps interest rate type narratives that are floating in the marketplace right now economically versus what some traders may view as a prediction or some kind of an impact because of future expectations for the election? Is it more tilted one way or the other?
I think we all think about politics. We all think about the impacts in the markets, in the economy, but I think we all think about the economy more. And to me, that's the most important thing that's out there. Certainly, there'll be some sort of impact from the election. We've seen market volatility from elections around the globe, but then I think we kind of move on past that. And so I think the most important thing is that you have seen the economy narrow just a bit, notwithstanding that GDP report. You're seeing the labor market weaken, which is catching the eyes of everyone. I think the big question that's still out there is, can the Fed arrest that? Or is it too late already? Does the labor market already portend something much more recessionary on the outlook, which I still think we're headed towards that?
Mark, last word to you. From the chart setup, what's the most attractive part of the market right now, and what's the part you'd stay away from?
I still love technology, Dom. I still love industrials. I think that's a phenomenal group. Financials has done well. I think energy makes sense to consider trimming and or avoid, given that the current administration likely is going to continue to pump output to get inflation down. And I think the new administration potentially would also ramp up U.S. energy infrastructure, and that could be negative for energy. So that's an area I probably would avoid.
All right, tech and energy. Brent Schutte and Mark Newton, thank you both very much. We'll see you again soon, guys.
Thanks.
Thank you.
And Treasury yields are moving